So I've had a call for the last over 2 years that come 2021, the 10-year Treasury will be at 6%. And I get a lot of pushback. There's a lot of debt deflationists out there in the Twitter sphere and the blog sphere, and they say you're absolutely wrong. The economy can't handle higher interest rates. But, you know, interest rates might have a life of their own. It might not matter what the market can handle or can't handle.
They haven't to this point. It's been somewhat surprising that rates have remained where they are. I mean, you said 3%. They hit 3%, 3.25, got to 3.25.
Yep.
And here we are below 2.9 today.
Yes, on the 10-year. I was really focusing on the 30-year, which I thought when it broke above 325, that was incredibly important. Frankly, I didn't think we'd ever go back below 325 once we broke above, because it seemed like such an important level. But here we are, we're back below 325, but not impressively. Not in a way that would be consistent with a big decline in the global stock market. There's a thing called a death cross. It's the 50-day moving average, goes below the 200-day, and particularly when they're both declining, it's a death cross. Presently, about 80% of the countries in the MSCI World Index are in a death cross. 80%. It's amazing. And there was a chart that got a lot of play that was put out by Deutsche Bank about how many risk assets globally are in officially bear markets, down that arbitrary 20% number that, again, I don't really ascribe to, but it's so commonly used that they used it. And it's like the highest in the data series, going back to 1901. It's like 90% of the risk assets around the world in dollar terms are in bear markets. So it's a pretty widespread and coordinated set of weaknesses.
Are you saying that by embarking on this suicide mission that the Fed shouldn't raise interest rates this week?
I don't really think that's the main thrust of my idea. It's and this week, yeah, I think they shouldn't raise them this week. I agree.
You think they shouldn't?
No, I don't think they should. The bond market is basically saying, you know, Fed, you've got no way you should be raising interest rates. Look at the 2s, 3s, 5-year part of the yield curve, which are flat at 270. I mean, I guess that is corroborative of maybe a hike, but it's basically saying that in the year 2019, you're going to have a cut. This big, but a cut. That's what's priced into the yield curve. And in 2020, another cut. So the problem, though, isn't that the Fed shouldn't be raising rates. The problem is the Fed shouldn't have kept them so low for so long.
Sure.
The problem is that we shouldn't have had negative interest rates like we still have in Europe. We shouldn't have done quantitative easing, which is a circular financing scheme. But the problem really is the deficit. The Fed is kind of helpless here. The fact that the deficit is so out of control this late in the economic cycle, we have never before had the Fed raise interest rates while the budget deficit was expanding. It's never happened because usually the budget deficit expands in response to a recession. It's a way of stimulating to get us out of recession. But instead, we did it as a last gasp of keeping this economic recovery going by making it completely deficit-based.
So this morning, President Trump, once again, tweeted about the Fed, quote, "It's incredible that with a very strong dollar and virtually no inflation, the outside world blowing up around us, Paris burning, China way down, that the Fed is even considering another interest rate hike. Take a victory," he said. Stan Druckenmiller today, op-ed Wall Street Journal. The Fed should, quote, "pause its double-barreled blitz of higher rates and tighter liquidity." So they're right. You agree with them?
I do agree with them. I've been saying this pretty much all year. The double-barreled was actually, I mean, he may have borrowed that from me. That's how I've been talking about, that's how I've been phrasing it all year, that we're really been tightening interest rates in a way that's more than people understand. There's a duo of economists at the Atlanta Fed called Wu and Shaw who did a study a few years back. What was the effect of quantitative easing? If they hadn't done the quantitative easing and instead had taken the European model and gone to negative interest rates, how negative would those rates have had to be to have the same stimulative effect as the quantitative easing? And they concluded, and I don't know if they're right or not, it's very hypothetical, but their conclusion was that the quantitative easing amounted to 300 basis points of further cuts. So if they hadn't done quantitative easing, to have the same stimulative effect, Fed funds would have been negative 300 basis points. Well, let's just say they're right. Since they did about $2.5 trillion of quantitative easing, and it was 300 basis points, $2.5 trillion divided by 3 is roughly $800 billion. Okay? So $800 billion is divided by 4 means that's what quantitative easing is, one cut. So 100 basis points is 800 billion, so divide by 4, 25 basis points is $200 billion of quantitative easing. Well, so far, we're pushing towards $400 billion, and we're not there yet, but we're soon to be there, of quantitative tightening. That means we've had 2 more rate hikes from quantitative tightening if Wu and Shaw are right. So the Fed hasn't just raised rates in that context 8 times, they've raised them 10 times. And the quantitative tightening is stated to be as high as $600 billion over fiscal 19. So that's another 3 rate hikes. So if they were really going to follow their dots and raise rates so many times, there's another 3 on top of that. So the amount of tightening has been underappreciated, I think, and Stan is right, as he often is one of the greatest investors ever. For him and Chanos, I think, are the two titans of the hedge fund industry. They're right that we are seeing the bond market react in a way that is historically very predictive of the Fed should not be doing this. And yet we have this strange dynamic that they've almost promised a rate hike here in December, and then the president shows up with his tweets trying to bully them into not doing it, and it puts Jay Powell and the team in a very tough position because they're damned if they do and they're damned if they don't.